Hello Wolfpack. This was a requested video on my Telegram group, and I want to talk about risk-reward ratio in this video just briefly. There's not really too much to cover, but I do want to talk about it, and this is the actual mathematics in the sense that, what is behind risk-reward ratio. And you can see we've got, for example here, 1:2, which essentially means risking $1 to make $2, 1:4, risking $1 to make $4. Obviously, you could do 1:16, which means risking $1 to make $16. And obviously, on a surface level, the higher the second number is, the less, the more reward you're gaining to take a stand for in exchange for your dollar, right? And you'll see this on trading signals. For example, sometimes on my Twitter, I'll release a trading signal or something similar to a trading signal. I'll add at the end of his trading signals 1: something, depending on what the trade is. So if I think that, something is going to go up 30%, right? My take profit is at 30%, but I have a stop loss 10% lower. That would be a 1:3. So for every $1 I'm risking for that stop loss, I'm standing to gain $3. And the reason why I don't think this is an extremely effective way to kind of measure risk and measure reward is because I think it's quite misleading, right? And I do it occasionally. I don't do it too often because I don't really release direct trading signals too often because I want to leave some of the stuff up to interpretation for you guys, because I don't want to be a trading signal channel per se. I just want to be presenting information, and you guys can do whatever you will with that information. But I throw out some ideas, and essentially one of the reasons why I don't really too often add in this risk-reward ratio kind of calculation, whatever you may say it is because, it doesn't give you an accurate example of what the actual risk is. Because, for example, if on every trade you're making, obviously this is hypothetical, but if every trade you made was a 1:2, which means you're risking $1 to make $2, on paper, that's favorable. But if you only win, or if you only profit on 10% of those trades, you're still going to be coming in at a net loss, right? Do you understand that? It's kind of hard to explain, but essentially you have to take into account how many trades you're actually profiting from, because it's all well and good that, every trade you're trading, you stand to make $36 for every $1 you're risking. But if you don't actually profit on any of those trades, or if you only profit on 1% of those trades, overall, you're still going to be coming in at a net loss. And this is why I don't think it's necessarily the best formula. I guess you could say it's a formula for, kind of taking into account a longer term time frame. Obviously, if I'm releasing one trading signal, if someone's releasing one trading signal, it's worth doing, and it is worth kind of calculating the risk and reward. But I don't think having a lower reward is necessarily a bad thing. For example, if you had something like a 1:0.5, right? So typically this looks like a bad risk-reward ratio, but it actually doesn't need to be. It could actually be very preferable. And this, just to explain, this means that for every $1 you're risking, you stand to gain 50 cents, right? Obviously on paper this seems bad in comparison to a 1:4, but the fact of the matter is, if this is the case, if you're taking 1:0.5 trades, but you win 90 or you profit on 99% of them, you're going to be coming in at a massive net gain, right? So it's all about what percentage of the trades you actually profit on as well. And I think there's another variable to this that people don't look at, and that is that variable, right? It's about how much percentage of trades you profit on, how much you lose money on as well. And I think people don't take that into account when they simplify it into just three simple letters, 1: this, 1: that. It shouldn't be oversimplified. And I think that there's a lot of people who are constantly seeking the high returns. And so a number like this, for example, if I just drew it out here, 1:75 or 85, which means that, for every $1 you're risking, you stand to gain 85. It sounds appealing on paper, but, obviously naturally the higher the reward, generally the higher the risk, and hence the lower the percentage of trades you're going to be profiting on. So naturally, and you know, you can do this for yourself, you can actually lower your expectations, and if you lower your expectations, you will probably start profiting more on trades. So I suppose what this is all about is whether you want to be a trader that consistently brings in small profits or very rarely brings in large profits. You know, and that's, you know, depending on your portfolio, depending on how much you're trading with, there's multiple factors. Preferably, you know, and personally, I should say, I like to trade with smaller rewards for lower risk, right? Because I think the crypto market is volatile enough, you know. I think that this is a market in which you can make 10x in a couple of weeks. And I don't think we need to be adding any excess risks and taking very, very risky trades. I like to trade coins that are still on the ground and have very close to support, very, close to MACD crosses, have bullish divergences on the RSI. And doing that, I can trade many coins per day. And, you know, rake in 2% here, 5% there, 15% there, occasionally 10% there, instead of just waiting for the 10x, you know, for months and months and months and losing over and over and over again until that finally happens. Yes, you know, there is a potential that if you wait for those big trades, you're going to be more profitable in the long run. But I think that consistent smaller profits is how you're going to build your strategy in trading. It's how you're going to reassure yourself that you're actually good at what you're doing. You're not going to lose self-confidence. Your emotions are going to take less of a toll on you. And it's overall probably most likely going to be more profitable because you have a realistic expectation. If you're going for these lower reward trades, you know, and even if the trade is high reward, but you're just cutting it off at a certain point, right? So say, for example, when I trade, and sorry if I'm getting a bit confusing here, guys, but if I trade, let's just draw it out here, a symmetrical triangle formation, right? So a formation, we've moved up into it, so we're bullish, and we're probably going to break out to the upside, right? Everything's telling us we're going to break out to the upside, and the target is all the way up here. I'd probably take profits a little bit before that target over here, right? Just for the, you know, the confirmation that I'm going to make profit rather than overextending myself, because in my opinion, it's better to be certain that you're going to make a small profit rather than uncertain you're going to make a large profit. Obviously, you can allocate or delegate certain percentages of your portfolio to more risky trades and certain percentages to more low-risk trades. And, you know, I certainly am a believer in that. I definitely have lots of coins that are very high risk, but I definitely have more that are relatively moderately low risk. And I think that as for trading, as far as trading goes, I like to trade low-risk trades with low rewards, because if I can pull in 5% 3 times per day, you know, obviously that actually seems very unachievable, right? Because that's 15% per day, but that's a goal, right? That's a target in my head. Anyone who pulls in 50% per day on a daily basis is straight up lying to you, right? If they're not a billionaire and they're claiming that, they're lying to you, because you can compound your wealth very quickly doing that. But the point of the matter is, if I pull in, you know, a few profitable trades per week, even in the single digits of percentage, I'm still going to be having a very, very positive overall net gain, rather than waiting 6 months for a 10x. You know, it's probably going to even out. And that's why I believe in delegating certain parts of your portfolio to certain risk allocations, because you can wait for a 10x for 6 months on one coin, and then also with another part of your portfolio be trading, you know, very, very low risk coins. So it's not necessarily about trading low-risk coins, but I think the fundamental point I want to get into this video, I got a bit sidetracked, but the fundamental point I want to get into this video, and the reason why I made this video is to kind of outline the fact that, you know, these numbers, 1:2, you know, risking $1 to make $2, it doesn't mean much. Because it doesn't actually tell you, well, who's making the trading signal, first of all. Are they actually knowledgeable? Where are they getting their information from? You know, how profitable are they as traders? So if you make up a trading signal, you've got it all mapped out, and you delegate your trading signal or allocate it as a 1:4, right? So you're risking $1 to make $4. Who says you're right? Who says that's set in stone, right? That's very, very subjective. And so I think that we should be taking this with a grain of salt. And the best thing to do is get a large sample size of your trades, very, very large. kind of understand how much, in terms of percentage of your trades you tend to profit on, how much you tend to lose on, and then you should be looking to find trades with a specified risk-reward ratio based on your statistics, right? And I can't make that for you. It's individual to every single trader. And obviously you can make, as I said, delegate different parts of your portfolio to high risk and delegate different parts of your portfolio to low risk. There's no reason to go completely low risk, and there's no reason to go completely high risk, because with low risk typically comes low reward, and with high risk typically comes high reward. Obviously there are exceptions, but just clarifying once again, whenever you see something, whatever you may see on Telegram, in a Telegram group, on Twitter, that says 1:85, doesn't necessarily mean that's the best opportunity you're ever going to get in the market ever, because the chances are, if it says 1:85, there's probably a 3 to 5% chance it's going to play out. Very unlikely, right? Obviously there are those rare cases where it does, of course, and we've had multiple of those cases. There are just simply times in the market where high reward trades do play out for very low risk, and that's fine, and that can happen. But I think these numbers alone are very subjective. Be careful with how you kind of interpret those numbers and utilize them. Take into account the percentage of the percentage of time you're going to win and percentage of time you're going to lose as well, because that's equally as important. Thanks for watching, guys. Hope you enjoyed, and I'll catch you in the next one.